Check my microphone. Sorry about that. All right, good morning, everyone. Let me just mute YouTube here. Mute that. Yeah, good morning. Thanks, everybody, for stopping by. Hopefully you got your coffee ready. I said everybody on Twitter that go grab your coffee, and I forgot mine, so I frantically tried to grab one and spilled it everywhere, so I'm got a big mess to clean up in about an hour, but it is what it is. Can't get through a live stream without the coffee, so. All right. So we've got, I'm actually not sure how long it's going to take, so I'm kind of just going to get right into it. We've got a little rundown here. As I mentioned in the introduction there, wherever you found the link for, we're going to try to discuss the age-old question of whether volatility metrics, such as the VIX index, such as the VIX futures, for example, all the volatility metrics that we talk about at VTS, whether they are best represented as a percentage or as a point move. It's one of those kind of funny, interesting things that you see on Twitter where if you post about volatility metrics as well, I'm sure you know what I'm talking about, but you'll post something about the VIX moved, X percentage or something, and inevitably on Twitter, somebody's going to come by and say, well, the VIX is already a percentage, so, obviously you don't know what you're talking about. There's no reason to post it as a percentage. You're supposed to do it in point moves. So it's kind of a little inside joke in the volatility space, but there is some truth to it as well, and I'm just going to unpack a few things. Spoiler alert, there really isn't a right or wrong answer, so I'm certainly going to get into lots of examples, charts, and everything to at least illustrate from my perspective why I say there's really no answer. But yeah, if you've come here for some grand answer, it has to be points, has to be percent, you're in the wrong place. I think by far the most important thing to keep in mind today is that whatever type of trading that you do, the leading authority on your investing is you. So if you feel like percent better represents your data, then do that. If you feel like point moves give you more accurate readings, then do that. It really comes down to the question is being asked. So some of you who follow me on Twitter, you might be aware that this isn't sort of sparked by it, but I guess it was. This has always been on my list of live streams to get to. But there was a thread on Twitter. I started it, had nothing to do with the VIX, but a whole bunch of people came in and posted. It was actually kind of cool. A whole bunch of the people that I respect in the volatility space, some of the guys you'd think are sort of the big names in the vol space, everybody kind of came by and gave their opinion. It was kind of cool to see everybody's response. But the general gist of it was most people acknowledge that it really does depend on the question that's being asked, and then you go out there and you get the data, you represent it, and you analyze it in what best answers your question. So I always relate it to kind of, the volatility trading. It's a very broad term. It really doesn't mean a whole lot. I mean, it's so vast. It's kind of like sports, right? I mean, we have lots of sports. We have, hockey, baseball, basketball. They're all sports, but I think we can all agree there's quite a big difference between tennis and Thai boxing. So volatility trading is kind of the same thing. Even though there's a whole bunch of people that call themselves volatility traders, some people might be hedging tail risk with volatility, and other people might be exclusively trading options, and that's going to be vastly different than the first group of people. And then there's going to be other people who, when they say they're a volatility trader, they mean they exclusively trade volatility ETPs. There is a massive difference, lawn bowling to UFC, MMA fighting, very big differences. So, of course, as always, the world's leading authority on my investing is me, and the best authority on your investing is you. And I'm certainly not here to tell you what to do. If you find value in different things than I do, hey, I will not pretend that I know what's best for you better than you do. So, but we'll get into some statistics on, again, my perspective on things. So for those of you who are new, don't really know me, I'm just going to do a little 1-minute intro here, introduce myself, and then we will get started, because not exactly sure how long this will go. For anybody who's been watching my live streams, I have a tendency to go off on a few tangents and a few rants, so we'll see what we get today. But bear with me, 1 minute of housekeeping, introduce who I am, and then we'll get started. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff. I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. All right, so thanks again everybody for coming in. You all know the drill. Subscribe to the YouTube channel, of course. Give the video a like for me. Let's try to trick that YouTube algorithm into thinking I'm much more popular than I am. And let's get started. So let me pull up my notes here. As I've told many of you, I'm a minimalist. I'm a digital nomad, so I don't have 3 screens going on. If you see me glancing down here, it's only because I'm looking at my notes on my single laptop. I always look on Twitter. People post their trading setups, and they've got 7 monitors, and I'm a single MacBook type of trader. So yeah, like I said, we are going to go through some examples of my perspective. Again, no definitive answers here. If you find different value elsewhere, that is completely fine. Maybe there'll be some crossover. Maybe I'll say something today that makes you think a little bit. But I'm just going to, of course, go from my perspective. And I would love to hear yours. If you want to make a video yourself, if you want to write an article about it, I'd love to read that as well. So the first thing that I want to look at is what people are kind of talking about when they say percent versus point moves. So let me try to go over here. So I think, I can't really remember what sparked this whole thing, but I believe I was posting the VIX percentage change as far as like a list of the largest volatility spikes as a percentage change. And that's kind of what sparked everything. So if you're not aware, and this is kind of important because the answer that people will often give is that the VIX is already a percentage. That is very true. So if you don't know what the VIX index is, it's actually a lot simpler than people sort of pretend that it is. They have this idea that it's just some super complex, only people in the know what the VIX is. It's really quite simple. So it's just the market's forward expectation of how much the S&P 500 will move around. Now, the number itself is a percentage already. That's why some people will say, well, the VIX is already a percent. It's a little bit redundant to quote it as percentage moves. I'm not very convinced by that argument, as I'll get into later. But yes, if the VIX is at 16 right now, that is essentially saying that the market is pricing based on options activity in the S&P 500 that over the next 1 year annualized with a confidence interval, 1 standard deviation, that the S&P 500 will move plus or minus 16% over the next 1 year. So it is a percentage. It's not $16, it's not 16 points, it's 16%. So that's kind of important to know, that little bit of a backstory when people say that to you, that, it's redundant. It's really not, but that's where it's coming from. But essentially, if you plot the VIX point changes, because remember, let's say the VIX goes from 16 to 20, you could quote that as a percentage move, but you could also quote that as a 4-point move in the VIX. And so if we plot the daily point change to the S&P 500, we get a nice plot here where it's definitely instructive. There's definitely a correlation here. There is a pretty strong inverse correlation, at least stretched out over multiple days and weeks, that, inverse correlation between the VIX and the S&P 500. So this quadrant here, we should start to see a bunch of points where If the VIX goes down, or sorry, if the VIX is going up, the S&P is going down, looking for them this quadrant, and vice versa here, right? Of course, if the S&P 500 is going up, we would expect the VIX to go down. Long term, day to day, it can vary quite a bit, but long term stretched out. If we plot the percentage change, we get a similar looking plot. Now, the slope is different because the scale is different, but you can see that most of the points are distributed between there, and we get the right quadrant here, just like here, and the right quadrant in the lower right. Everything is good here. You're going to get good data for both of them, but this is where you as a trader will obviously have to weigh what question are you trying to answer, and then you will apply the data that best suits your data. So for me personally, when I'm looking at this, I would say that, yeah, if you're looking at S&P 500% moves and you want to know what's going to affect it and get the proper scale, there does look to be less outliers using the point moves rather than the percent moves. But that's not always universal across the board. You can have different examples. This is the VIX point move compared to the VXX. So this is a different measurement now. Of course, I should probably do a little sidetrack here and just remind people that the VIX index is not the VXX. I get just a million questions. Hey, how come the VIX went up 3% and the VXX didn't follow it? You have to understand that these are entirely separate things. So the VIX index is a calculation based on S&P 500 options activity. It's a freely traded market, the S&P options, and the VIX is not a tradable instrument. It is just a calculation, a statistic, based on S&P 500 options. The VXX, while it is tradable, it actually functions purely based on a methodology of tracking VIX futures, which is also a freely traded market. So there really isn't a whole lot of connection between the VIX and the VXX. But when you are measuring them in charts, for example, you will get data. You can say, because there is a very strong long-term correlation between them, as there is in many of the volatility metrics that we track. They're not directly correlated, and certainly day to day there can be large variations, but stretched out over multiple days and then weeks, it's a very, very clear relationship here. And the point moves does a very good job. If we go down to the percent moves, it also does a really good job. I would argue, if you made me say, I would say there's less outliers here on the lower one. So, I mean, of course, you do what you want, but I would say that the VIX daily percent change probably better represents the data as far as outliers go. They're a little bit more spread out here, a little bit on this quadrant. I just think that sometimes one data set is slightly better than the other. But importantly to remember through all of this today is that you're never going to get the wrong answer by going percent or number. It's really very, very hyper-specific to what you are currently doing in your trading. And then the last thing here, this is the VX30. So what the VX30 is essentially the front 2 months of the VIX futures term structure. As many of you know, we talk about this a ton here at my live streams. This is the VIX futures. The VXX trades based on the front 2 contracts here. That's it. The only based on how this is moving up and down in relation to converging to the spot VIX at expiration. The VX30 is just a representation of a single point based on the number of days to expiration. So if I get the exact number here, according to my daily email today, the VX30 constant maturity is 1947. You can see that it's not quite this number, it's not quite this number, it's somewhere in the middle. That's what the VX30 is. But when we look at the VX30, and we now, first of all, compare VX30 daily point change to the VXX daily percent change, very good data set. Obviously, these things are very, very related to one another, right? One of them is basically tracking the other, more or less. There's differences and complex calculation, but yes, we should see a very strong data set. But again, I would argue that percent changes is just getting you a little bit more accurate data, a little bit better distribution, really getting to the heart of how volatility ETPs actually move around. I am much more concerned with the percent moves in the VX30 rather than the point moves. I'll get into this later on, but that is highly dependent on the starting value of where the volatility is. So that's why this data set doesn't really look as good, because the starting value actually matters quite a bit. So, but like I said, I'm not here to change anybody's opinion on any of this stuff. I'm just saying that, We have to understand that everybody's going to be looking at volatility differently. Everybody's going to be gathering metrics differently. And certainly, I will always pay you the respect to say that you probably know better than I do. So I can tell you which ones that I like and which ones that I use. But, that may not be universal for you. There's certainly value in all of it. And you're not going to get wrong answers. But I touched on it a little bit. And now for my second point, you have to remember that the starting value of volatility is very relevant when you're talking about point moves, where it's far less relevant when you're talking about percent moves. So as an example, I think we can all agree there is a very big difference between the VIX index moving from 10 to 15 versus the VIX index moving from 35 to 40. Both of those are 5-point moves, but one of them would be absolutely devastating to the market. If the VIX was at 10, like it was in 2017 for a majority of the year, if it suddenly went to 15 in one day, that would be a day that goes down in the memories of all traders. It would be absolutely catastrophic. But the VIX going from 35 to 40 or 45 to 50, that might just be a regular Tuesday when the VIX is already high, right? I mean, if it's already at 35 or 40, it's a very short trip to go up 5 more points. So I think that it starts to lose its value when you're measuring point-wise based on the starting point. And that's what I'll show you here. Another example, again, this is not meant to convince anybody of anything, just the way that I look at things. If we look at a chart, and I often post this, and whenever I post this on Twitter, you better believe somebody's going to come around and tell me that I'm wrong for posting the percentages here. I kind of just laugh it off because obviously I know what I'm doing, and I trust that they do as well. But this is the top 25 largest percent change VXX spikes since 1990. So this list are all the days where most of these days are quite memorable for really kind of out of nowhere volatility spikes. But we can also plot this in point moves, right? We can do the same thing. We can just do the largest point moves. There's a couple of differences between these two lists to notice. The first one is, if we kind of glance at some of these dates on the percent changes, a lot of them pop out in our memory as ones that we should remember, right? Volpocalypse, obviously it's going to be a very big one on the other list as well. Volpocalypse is right here, number 3 on that list. It's number 1 on this one. Now, side note, if we use the old VXO calculations and get the VIX before 1990 back to 1986, we will know that actually October 1987 would dwarf everything on this list. So I'm certainly not saying that 115 in a day is the most it could ever go. Got to remember, the old VXO went from the low 30s to 150 in one single day, and an intraday high of 172. So it can go way, way more than 115%. But Volpocalypse being number 1, the interesting one I think here, one of them, I'll get to another one in a second, if this date doesn't ring a bell for you, maybe some people watching know what this date is. Maybe if you've been trading for a lot longer, you're a more seasoned veteran, you will remember the Asian currency crisis, right? February 2007. That was a devastating day that a lot of people will remember. Well, because it happened when the VIX index was at 1115 the day before, the Asian currency crisis doesn't even come close to registering on the largest point moves. So I guess it's a non-threatening day, but actually it was a very threatening day. What you end up finding on a list like this for VIX point changes is what we're really doing. If we look at a chart, let's do the VIX for 15 years, look at a weekly, so it's all on the same page. And then we'll do the VIX. If we look at this list and we're using the point moves, which a lot of people will say is the correct way, percent moves don't count. If you compile a list of point moves, you're really just compiling a list of the largest VIX moves when it was already around 25 or 30 or even 40 and 50. That's really what this list is. You can see the vast majority of these dates are going to be COVID, financial crisis, European debt crisis. They're going to be, call it the China hard landing scare in August 2015. Those are the dates that it's going to be. But the percent change, of course, it has a little bit more of a relative change factor built into it. So you can actually start seeing readings, 2017, 2013, 94, 2016. They're not all just the crisis dates. So that's one thing that I would say. You got to you got to really ask the right question and then answer the right data. If you want me to tell you when the VIX moved the most as far as point moves, well, I mean, look no further than the financial crisis when it went up, it closed at 80, or COVID when it closed at 82, 82.69. You're going to get an awful lot of large moves on those 2 days. And then fill it in with the flash crash here, debt crisis, China scare, Volpocalypse, Q4 2018. That's really what you're compiling. I don't think that's overly helpful. So whenever I am posting this chart on Twitter, that's why I post this one, the percent changes, rather than this one, which I could post. I just don't find it a relevant list at all. I could post the point changes. So that's one thing. The other thing that I want to point out here, there is another date that I think you don't have to have been trading for 14 years to realize that there is one date that is very specific and it is missing here. And I think it is very relevant to the conversation. If we look in this date, number one largest point move in history, at least back to 1990. Again, VXO to Black Monday would be worse. But there it is, March 16th, 2020. COVID, right? Number two, March 12th, 2020. If we look at a chart of SPX, let's go, what? We only need, what, 2 years? 2-year daily. If we look at where those dates are, this is March 16th, right down to there. That's the worst day as far as VIX point moves. Well, what about this day? Who here watching in the stream is more concerned about what happened here rather than what happened all the way down here? I would submit that if you're an investor and this day rocked your portfolio, I think you might have some problems, because certainly this is more relevant for me. Again, I'm not going to tell you it has to be for you, but I am much more concerned about what happened on February 24th. What is the first date during the COVID crash in 2020 that we see? Well, there's June. That's not the original COVID crash. That's later in the year. The very first problematic date is that one, February 24th, a 46.55% VIX percent spike. This is the date that I'm concerned about. Well, that date, of course, that's only a 7-point move. That's not even on this list. So if you use the wrong data, sure, this date is devastating as far as a point move, but surely as far as a relationship to a portfolio, this is the day you really wanted to be exiting to safety. And that's kind of why I say that this is personalized to me. But if I show you my daily email that went out to the community, 1,000 people read this email, February 2020, February 24th, the day of the 9th biggest VIX spike in the last 30 years on a percentage basis. You can see like all the metrics are kind of red. This is flashing negative. But what positions was I in? Well, I was already in bonds the day before, and I moved outright gold, right? VB threshold was already in bonds from the February 21st, the day before. Our short vol strategy was already in cash from previous. So actually, we exited right here. We didn't suffer a single percent drawdown in the COVID crash. If I would be the type of person who actually has to wait for all of my metrics to start showing percentile rankings based on point moves, I might have actually had to wait until somewhere down here before getting my signals, because that's not going to show the relative change. The VIX has to get to 30 or 40 before it really starts flagging those levels that's going to show up on something like this, or start making my actual portfolio move full on to safety. But of course I want to make sure that I'm getting what I call the pivot point, the relative change point. The markets were doing great, and then all of a sudden they weren't. I'm much more concerned about this point right here. And the same thing applies if we go back. I can actually show you the VIX while it's pulled up here. But the same thing applies to the VIX. This is February 24th. From this point down here to this jump here, this massive gap, that's the date that I care about. The point move, that's this date up here, right there. The very, very peak. And again, like I said, I'm not telling you, what you should or shouldn't have done. But if that date was the one that is burned in your memory, if March 16th was in your memory, not February 24th, I would say that at the very least, we are trading a different market, because this is the day that I think affected most people. This day is just, par for the course when the VIX is already at 60. So the other thing that I could show, and again, this is personalized to me, but Q4 2018, this is October 5th. And again, I just want to show the positions we were in. We were, on this day, we moved to safety bonds. We were already in cash for this strategy. We were already in cash for this one. Moving to cash here, bunch of options positions, delta neutral iron condors, long SPY straddle. But essentially, I moved to full-on safety in my portfolio on October 5th, 2018. Well, again, that kind of came out of nowhere. That Q4 2018, the VIX was coming off fairly low levels back then. It was in the teens. If you're the type of person that's looking for big point moves in all of your volatility metrics, if you compile your list, and I've got my list and I know you've got yours, and half the people watching, we're all volatility traders. If you're the type of person that's using point moves rather than how I rank everything based on percentiles and relative change and differences in momentum and pivot points, you might have completely missed this and had to wait all the way over here, right? But I caught it, right? Oh, sorry. Let's look at the SPX during Q4. Where's October 5th? Right there. That's where I caught the Q4 2018. But again, the VIX is coming off levels and the market was fairly stable. This could easily be missed if you're using point moves. Point moves start to really register very high on big slides like this, big ones like that right there. But that's too late. I'm the type of person, I got to exit before that. My entire portfolio is based on reducing drawdowns. I'm not the type of person that chases big gains and then basically holds on for dear life during drawdowns. We exit early, and that's the strength of my portfolio. So certainly that was the case for me. I had to exit early. And again, if you want to see another example, the third example, Volpocalypse 2018, February 5th, the second worst day in history, we'll call it. We'll still say Black Monday was worse. But blog here, again, cash, moving to gold. We were already in bonds on the 30th of January. Options were already closed out. Conservative vol was already in cash. Aggressive vol was already in cash since January 29th. If you want to see where those dates are, SPX, January 29th is right there. So this change of position, and that was a rough day. I mean, we feel it on the first day. I'm not Nostradamus. It actually requires a little bit of a hit early on to get me to move to safety. But this hit was more than enough for me. The relative percent change on that move, that change of direction, was more than enough to get me into safety. And we actually, of course, again, for the third time, in all of these major crashes, made a profit for that period, for the next, several months. So again, I want to reiterate, I'm not here to tell you that, my method is better and, you do your thing. But honestly, you can get good data doing both of them. And I could go through this for hours. There's plenty of other ways to look at it. But point moves has its place, for sure. Point moves is it's definitely meaningful. I'm not trying to dismiss that. Especially, like I showed, if you're trying to do SPX, or there's a lot of people who are on, say, the institutional vol side who would be certainly better suited for using point moves. The point is, you're not going to get any wrong answers here by doing either. It's just how you look at it. It's just the questions that are being asked. If you had to ask me, gun to my head, if I had to take a ballpark guess, I'd say I'm probably in the 70-30 range. 70% I would be looking at point moves as more relevant to that question, and maybe 30% of the time I'm looking at percent moves. With volatility trading specifically, volatility ETP trading, VXX, all the stuff that we do there, I would say it's probably a little bit more skewed to the percent side. Because again, for my investing, I am not the big profit type of trader. Let me close some of these. We're not the types that are absolutely crushing the market during bull markets. Wow, there's a lot of pages open. Hopefully you can see this. But the strength of my portfolio is entirely based on exiting to safety in the most timely fashion possible. And for over 9 years of live trading in the VTS portfolio, we've kept our drawdowns to a very low level because I am mining relative change, changes of direction, more so than just, wow, that 20-point VIX move was a real big one. It's probably far too late at that point. If you're focusing on the 20-point move, you probably find your portfolio down substantially at that point. So for me, that's what it is. But you know, I don't like the argument from authority. Somebody comes in and says, well, here's my results, so I'm right. When people come in and they say, you know, the VIX is already 1%, it should be measured in points, and then you say, well, I disagree, I find plenty of areas of benefit when I do the points or the percent moves, and then, you know, inevitably somebody will come in and say that they have a certain degree or they went to a certain school or they're a Vol PM and therefore they know best. That's called an argument from authority. It's a logical fallacy and it doesn't mean anything in the quant space. Focus on what you do and what's best for you. Don't think about what another PhD tells you that you should be doing. So it's kind of like, if Warren Buffett says something that's true, right? He says a statement and it's true. You might have a negative opinion of the guy. I don't know. Maybe you do. But if what he said is true, then it's true. If he's on the flip side, if he says something that's incorrect, I don't really care how much money he has in the bank. I don't care what his track record in the past is. If what he said is wrong, then it's wrong. So things are true or false based on the merit of the argument, not the person saying it, and not the degree of the person that's saying it. So I found that thread to be super instructive and informative, and it was really cool to see, 20 or 30 of the VolTwit, Vol pros come in and chime in. But again, if you're on this stream to get some definitive answer, unfortunately, you're going to leave disappointed because pretty much everybody in that thread agreed that it's situational. It depends on the question you're asking. It depends on the type of trading you do. It depends on your portfolio. Your answer as a volatility ETP trader might be vastly different than somebody else who's trying to delta or gamma hedge a portfolio. It could be totally different data sets. So let's be respectful for each other, that we all are the world's leading authority on our own systems and not other people's. So if you want to use percent, you go for it. I support your decision. If you want to use points, that makes a lot of sense in a lot of situations too. So there you go. There's my little rant. We got through it without going off on too many tangents. Could have, but I think the point is pretty clear that there are definitely situational times when points just makes more sense, and then other times where it just would be almost meaningless data. So now the other thing that I said in the rundown, probably the most popular part of the live streams is the live Q&A. You can ask me anything you want. But I did mention that if we have time, so I was ranting there for 30 minutes. Give me 5 minutes to wrap up the whole UVXY reverse split stuff that went on, because there was a lot of emails. I mean, my email inbox was absolutely flooded. And I feel bad for people that didn't see it coming. I do want to just remind everybody very quickly that if you're new to my streams, just remember that there's almost 1,000 articles and videos totally free out there. I always say 90% of my work is completely free. The only thing that I charge for is the actual trade signals of the portfolio. Everything else is completely free. And we did multiple live streams on the VXX, the UVXY reverse splits. So if you didn't catch those and you caught yourself into some trouble there, I'm sorry that you were blindsided, but let me just quickly review very quickly here. You can watch that. Those streams are an hour long. But essentially, when we look at the UVXY, the most confusing thing for people was the split happens, and a lot of the brokers on the front end of the platform, sometimes they start mispricing things. Sometimes the bid-ask spreads are all over the place, and you might go into your account and think that you've lost a whole bunch of money and they stole your money. I got that a lot in my emails, that, how dare they steal my money? Nobody told me that I had to sell my options. You don't actually have to sell them. So the first thing to be aware of is this is right now, UVXY. Everything that says 100 next to it, these are the new contracts that you will be focusing on, right? Everything that says 10 over 100, those are the old contracts before the split happened. So if we open up this one, you can see these prices for the strikes are very low. And then if we open the new one, we can see these strikes are actually pretty high, right? 10 times higher. That's because they did a 1-to-10 reverse split, and instead of, so when you have the shares, for example, it goes from 4 to 40. The price is multiplied by 10. The outstanding shares are divided by 10. No value is lost. If you were holding UVXY, everything is exactly the same. The only thing you have to be aware of is anything not divisible by 1, they do cash settle that. So for example, if you had, I don't know, you had 45 shares or something, and then when it's split, of course they can't give you 4.5 shares. So after the split, you would have 4 shares at a price of 10 times more, and then that half share is just going to be distributed to you in cash. Probably, it's typically within a week or so, within maybe 10 days. I don't know the date, but you will get that cash. No value is lost. In the options, as far as clearing options go, it's actually a little bit of a nightmare to be changing the premiums, changing the contract size, changing everything on the option side. So all they do, because options are always one contract represents 100 shares of the underlying, all they have to do in a reverse split is just change that ratio temporarily until these expire. So whenever you see 10 over 100, 10 over 100, that just means that the option ratio temporarily until that contract expires is going to trade 10 to 1 instead of the usual 100 to 1. It's no big deal at all. You know, you're not going to be entering any new option strings that say 10 over 100. You're going to be denied at your broker. It's going to immediately tell you can't do that, but you can still close out any positions you have. The only thing, you know, best practices that I always remind people, and the way that UVXY is trading and the way that VXX is trading recently, we might have to do another live stream soon trying to predict when the next reverse split is, because this thing is crashing pretty hard. But the only thing you have to keep in mind for next time around is that if you have options that are sensitive, that you anticipate you may actually have to adjust or do some changes on the split date or a day or two after the split date, in that case, you're definitely better served to just close the position before the split and then wait a few days for the market makers to catch up with the new option chains and then reestablish a materially similar position. You probably, if you know you're going to have to do some action, or at least maybe you would, you don't want to mess around with how quickly your broker gets everything together. Just sell it, just take a few days off, and it really doesn't take long. In this case, remember the VXX split later in the week, so I think it was Thursday night, effective Friday morning, and so they didn't have time to introduce the weeklies, and so we had to wait actually 3 or 4 days the next week. But the UVXY split this week was Wednesday, so the weeklies were out almost immediately, and there wouldn't have actually even been that much downtime. So, but that's the only thing I say. No values lost. Nobody stole your money. The UVXY was not manipulated during this process. I can be sympathetic to why you might have thought that, because your broker platform probably said that, wow, your dollar value just plummeted. But nothing was shady. It happened as usual. Just be aware that the market makers are not necessarily going to be in there the next day with the full option chains with full liquidity. So if you have sensitive options, you are better off to just close them out. And if you have long options or short options now, if you're doing things longer term, you don't necessarily have to close ahead of time, but just be aware that the longer you let those go, you know, you might run into some liquidity issues as well. So, you know, just when convenient, get out of those positions, reestablish in the new ones that say 100 next to it rather than 10 over 100, or in the VXX case, 25 over 100. You can see some of those are still there as well. That was because it was a 4-to-1 split or 1-to-4 split. But yeah, that's all I want to say about VXX and UVXY. Both splits happened. They were uneventful, but yeah, my email inbox was absolutely a nightmare. So I will again do live streams next time around, and I will try to give you all a heads up and you know, give you tips on how to not feel like you got screwed by your bank or your broker or whatnot. You won't. Although I should preface that there was a little bit of a disaster back in February 2018 where they deleveraged the volatility ETPs, and there were definitely reasons to be upset about what happened there, because depending on what side of the trade you were on, you could have lost a lot of money. And that, you know, I'm not going to go as far as to call it theft. I don't think that word applies, but gross negligence for sure. Lawsuit worthy, definitely. But But yeah, reverse splits themselves, they typically go off without a hitch, no problem. All right. I almost reached for my jumbo Costco bag of chocolate almonds, but no, I'll save that for after. So let's get to some questions. I don't know if anybody minds. Can I open this? Let's see what the sound is like. Am I getting a little hot? Hopefully there's no construction outside. All right, I'm going to go to the very top. We can never get through them all, but we will see. So first question. How do you determine what strikes to use for the vol trend? Today, shorting 33 puts. So yes, today we got into, where's today's email? Today, the vol trend position was we are closing out the one from this week, and we are getting into the VXX 33 puts for next week. So I would say, let me pull up that VXX. So as far as deciding, this is the chain that we're looking at. As far as deciding between the 33, 32, whatever it is, I would say it's discretionary, but it is based on modeling, right? And I actually, what you want to look at if you're really interested in a deeper dive of this, let me think about where I actually put that. Let me close out this spreadsheet. We're done with VIX point and number moves. And let me open up another spreadsheet. I'll be able to better answer this question in a second. Sorry, my Mac is also real slow opening and closing spreadsheets. But yeah, I would say it's largely, it's probably a mix of discretion and a systematic approach that I take based on multitude of metrics, like how much volatility decay is happening, right? Some of these metrics are very relevant for the vol trend specifically. I'd say the vol crush, say the VX30 to VIX ratio, you know, the roll yield as we call it, very relevant to that strategy specifically. And I'm basically pricing things in. Traders VRP comes into play a little bit. Obviously the volatility barometer comes into play. But there is an inverse relationship between a lot of the strikes that people will be choosing. So let me open this. Vol trend overlay. I know I've got it. Bear with me here. What would I have named it? Premium comparison? Okay, good. Nailed it. So this isn't the actual price, right? It's changed since I updated this. But essentially, you'll get the idea that depending on the strike you choose and the premium that you bring in, these two things, well, these three things will be changing. So for example, this 36, right? You're bringing in less premium. So the distance to strike is much farther. Whereas if you did the 37, you're going to get a lot of premium for that, selling a put that is closer to the money, but the distance to strike is closer too. But then you also have to take into account that it includes the premium. So the distance to break even actually closes the gap a little bit there. So it's not strictly necessary to absolutely nail the correct premium and the correct strike that you're selling. We're going to do the 33 for next week because it's A, it's a 4-day week, and B, we've seen massive vol crush already. So we've seen just an epic crash here. It's not impossible that it continues at that slope, but what's more than likely is it will probably bottom out. I'm not saying that it'll go up, but certainly we would expect that it can't go down 5 or 6% forever. So it's not based on this, like you can see, the distance to break even kind of closes the gap a little bit. Even if you're trading well in the money, for this example, this is the money right there. So this 39 would be in the money already. Massive premium up front. Distance to strike is already out of the money, but distance to break even is still positive because you get to subtract your premium again. So I don't like to go here unless I really have a reason to, but choosing between 2 or 3 strikes is very normal to just kind of, I'm not going to say it's eeny, meeny, miny, mo, but you know, the 33 looked pretty good considering, you know, if there was a 32.25, maybe I would have taken that, but I like that 33. We still get that, so the break even is 32.50. To go from 33.84 to 32.50, not saying it couldn't happen, of course it could, but again, 80% of our portfolio is net long the market, net short volatility. So even if this trade went against us, well, it's kind of part of the strategy that sometimes they do go against us. As everybody in the community has seen this week, we had a vol trend trade that will You know, it's not the worst I've ever had, but it certainly certainly lost some money, and that's never fun. So, yeah. But you know, the 32 is also fine. The 34 would be fine as well. I just I'm feeling that 33. Where am I broadcasting from? Still in Vancouver. Still stuck. Travel restrictions. Still trying to get to Dubai or Panama, or back to Taiwan. Just kind of back to my, not really home, but where I spend a lot of time. Vancouver, Taiwan, I spend a lot of time, and then travel the rest. But I'd really like to get to Dubai or Panama. Just can't. Just can't. The second, third, what are we on, the fifth, sixth wave? I don't even know. But still in Vancouver. This is Cole Harbour, if you're interested. Yeah, very cool place. I like it here a lot. You can see my running path. Oh, mirrored image. You can see my running path. I'm going to go running in about 20 minutes here. Best way to contact me? Email volatility trading strategies at either gmail.com or at hotmail.com. Check them both. If you have more complex questions to ask, you can always email me. If you've got simple stuff, you can jump on our streams. We do a lot of these, and ask anything you want. What you do is really high-end art in investing. Ha! Thank you so much. That's a nice compliment. I'm an artist. I actually joke about how I'm the least creative, you know, least abstract person ever. I mean, naming these live streams, I had to poll the community, and I still haven't decided on the name. I have no artistic ability whatsoever in me, but thank you for that. I'm the artist of investing. I like that. Do you have somebody, a student for example, who will continue your work if something happens to you? Hopefully I don't get hit by a bus. Nowadays world is very safe, but we're still just people and anything can happen. So some type of contingency plan? No. The thing that I always say, because our emails go out every day before 12 p.m. Eastern time, every single day that there's a market trading, right? Monday's a holiday, for example. There won't be an email that day. But before 12 p.m. Eastern time, if you don't get it, number one, very likely your spam filter blocked it. So check your junk folder. It's probably in there. If it's not, email me and give it a super obvious name, like, because my email, it fills up fast. So name, no email, urgent, something like that. I'll see it for sure, and I'll send you a copy of it. If you've exhausted both of those options and you don't get, you know, you don't hear back from me, then hopefully I didn't get hit by a bus. Hopefully I'm just somewhere that, you know, internet went down or something. It's never happened before. I've managed VTS since January 2012, never missed a day. I've only been late. I think I was 7 minutes late once. So it's never happened before. If you don't get it, the way that my portfolio trades, there's never anything wrong with moving to cash, because essentially I'm measuring the metrics day to day and giving out new trades every day. Now, we don't switch every day. If it's a maintain the same, then it's maintain the same. We don't exit and re-enter. But I measure everything on a single day basis. So there's nothing wrong with moving to cash. If you don't hear from me and you suspect that something happened to me, certainly move your portfolio to cash. It's no big deal. I'll certainly be here for decades. Missing a couple of days until you get more clarity, definitely do that. But no, it's just my work is me. It has to be me. It's built upon my experiences, and there's nobody else that could fill in for me. At least not now. I could train somebody, but I have no plans to go anywhere. I'll still be here. So this is a new name. Welcome. I think this might be your first stream. I don't recognize that. Or your first question. If I just followed leverage, threshold, and aggressive volatility, is Voltrend a good addition to use just these two strategies? Or is it not a good idea because I'm not a broad market indexes? So really good question there. What I would say is if you're only trading two of them, so this is, I put this together every day and I send it out in the email. It's just one of many of our metrics. But this is essentially the exposure of our portfolio. Now these are 3-year rolling beta factors, so it changes over time, but currently these are the betas of our actual broad portfolio. And I consider our exposure this. So if you are only trading the aggressive vol and the defensive rotation, then technically you're missing out on some of the leverage from the other two strategies. Or let me just confirm, which ones did you say you were into? You said aggressive vol and leveraged threshold. Yeah, so if you're only taking these two, then you can still get into the vol trend strategy, but if you're an annual subscriber, you are certainly not going to be interested in the overlay, because now your market exposure to either net long equities or net short vol is not going to be sufficient to offset those times when the VXX crashes really hard on us. Like this week, we got hit really hard with a vol trend trade where we sold a VXX put and it actually crashed through our strike price. But the rest of the portfolio, of course, is pretty aggressively net long, and same with the unleveraged, it's still aggressively net long. So it's kind of okay. It covers up the mistakes. But if you're only trading two, this is a situation where you definitely want to email me. I'm not a registered advisor. I can't give you any personalized advice, but I can certainly give you a better explanation on how to piece together your beta factor for your portfolio and how to scale that to the vol trend for you. Because that vol trend, you don't want that beta offsetting the rest. And it is kind of specific to the person. So email me. There's a lot of questions, or no, there's just two here. Would a good strategy to be always sell the VIX minus M1 future month after month and always roll into the new M1? No, that would be, well, again, I really don't like definitively saying no. Actually, I can pretty comfortably say this time. Yeah, no, that's not a good idea. Essentially, what you would be doing is just selling a rolling short vol position. You're going to feel like a hero for several months in a row, and then eventually it's going to catch up with you and it's going to blow up in your face. So no, the thing about option trading, futures trading is the same thing. They're kind of very efficient markets. Not 100% efficient. Of course, high frequency trading can sometimes find a little bit of arbitrage, but for our purposes, the options market, the futures market, they're very efficient. So doing anything blindly on a schedule is never going to work. It doesn't matter whether you're buying vol on a schedule, you know, every 30 days you buy a at the money straddle, or doesn't matter if you're selling vol, you just repeating selling the M1 and every time it expires you roll into the next one. Doing anything blindly on a schedule has no edge whatsoever. So depending on the risk reward ratio, your win-loss rate will balance out, and I would expect your long-term return to be about 0% minus trade fees. If you have no edge and you're not applying any knowledge to what you're doing, you're just rolling something, then yeah, 0% minus trade fees. You've actually got to apply an edge, whether it's a knowledge edge, experience, data specific, position sizing. There's a lot of ways that you can find an edge in the market. But rolling blindly, I know it seems like a good idea because most of the time vol is decaying, but it's just a pure function of the risk reward ratio. If you get blind trading, if you're selling at the money, you might get much closer to a 50-50 ratio. If you're selling way out of the money, you know, you're reference to an old kind of a fraud out there, Karen the super trader style stuff, where you're selling so far out of the money that you're just telling all your clients, well, it'll never get there. Yeah, true. Maybe 98% of the time it won't, but the reason the options are priced the way they are is because sometimes it does get there. Rarely, but it does get there. And then you end up, you know, you might have 18 weeks in a row where you had winning trades and then you pay it all back in one disastrous result. So no, I would say you want to examine how to add several layers of edge to your trading. There's nothing wrong with selling VIX futures. There's nothing wrong with trying to target the fact that most of the time volatility goes down. That's what I do. That's what a lot of us do. But don't confuse that for, hey, let's just do this and roll it every 30 days. That's going to end badly for you. Okay. I have a question very relevant for vol traders concerning the weekly and monthly VIX option settlement price set by the CBOE. Okay, I don't like to talk too technical because you're going to lose most people today. On May 19th, the VIX opened at about 22.20, and after a trip up to 26, it closed back at about 22.30. Oh, you're going to talk about the special calculation, aren't you? I was therefore surprised to find the CBOE settlement was 25.20. Well, I'm not going to get into it. That's sort of a... Oh, yeah, you're getting into it. Let's keep going. I was going to say the Found this through Google. Good job. You can find the answer here. The exercise settlement value for VIX options, VRO, is a special opening quotation of VIX calculated. Is there more of this? This is it. That's the last part of your question. So yeah, essentially, the VIX is a little bit weird. It technically closes for trading Tuesday night. Options expire the third Wednesday. Well, it's better to look, mostly the third Wednesday, but technically speaking, it's 30 days previous to the following month's SPX expiration. So you can go to the following month's SPX options expiration, backpedal 30 days, and it's typically, unless there's holidays or special, vacations, it's typically the third Wednesday of the month. But actually, it's the third Tuesday night, and then the first 30 minutes of Wednesday, they're going to do this special calculation. It gets all weird, and today's live stream was about the VIX percent move to the number move, the point move. I mean, we could also do one of these back and forth between, is the VIX manipulated? Is the options expiration manipulated or not? Yeah. Okay. You want my opinion? It just is what it is. It's just one of those things that it is what it is. It's weird. And what I would suggest to people, if you're trading VIX options, and I trade the VIX options market quite a bit myself, I've been doing it for so long, it's actually my longest running strategy, so I know when to let them expire and when not to. But what I would say for most people, unless you have a really good grasp of what's happening, and unless you have very large margins for error on that final day, it's probably, again, best practices to exit all of your VIX options trades before expiration. Because the actual change, by the time it settles to the Wednesday open, that SOQ, it can actually change a point or two on the VIX. It's not uncommon at all. So you might go to bed Tuesday night thinking you made money, and you wake up Wednesday and you get the settlement and you actually lost money. So nothing wrong. I mean, I know that people want to capture that last little bit of theta, but honestly, just close them out a little bit early if you're worried about it. Or if you have anything that's dancing on the edge, just close it out. And oftentimes brokers these days let you close things out if it's less than 5 cents. I would take advantage of that. It's usually free. Yeah, don't mess with that. But honest opinion, I don't think it's manipulated. I just think that's just the way the markets trade. It's just what it is. It's not ideal at all. And it's not how, if somebody redid the VIX today, I would imagine they would probably find a better solution. But it is what it is. It's just something that we deal with. So if you don't know what you're looking at, close early, always. Err on the side of caution. All right, another vol trend. Vol trend strategy uses selling naked options. How does that fit into your risk management philosophy? It's somehow a contradiction. Could be a contradiction. In general, I have a problem with selling naked options, but on the other side, on the call side, I've not a problem, a very, very big problem. I will go to war with this on anybody who wants to. If I accomplish anything in my YouTube career, if you want to call it that, it's that you really shouldn't mess with selling naked options on volatility ETPs. Probably shouldn't do it on any underlying instrument, but on volatility ETPs, they move too quickly. You're never really going to be able to control things. It's just a terrible idea. But there is a very big difference between selling a naked put option and selling a naked call option. So that's probably the difference. Or a naked straddle that has risk both sides. If you're talking about selling a naked put, technically speaking, let's open one here. Technically speaking, you're talking about an unlimited loss trade. Let's close all my live trades. This is the one. Technically, I mean, if you see, this thing could just keep going down. So it's got 4 trading days plus whatever's left over today. So 4.5 trading days. This thing could just keep going forever. Now, what do we know about the VXX is that obviously it can't go to zero. It's trading based off the VIX futures, and we know that that's not going to happen. It could get ugly for someone, but again, in my situation personally, the only reason that I do this strategy, what you could consider somewhat heavy, right? I give it a full 20% allocation. You can see that there. It's one of our 5. The only reason I do that is because yes, I'm short a VXX put, and it is naked. It is a undefined, unlimited loss trade. But I'm also net long the MDY, I'm net short the VXX, I'm net long the SVXY, and I'm long the Qs. So A, this can't get out of control because the VXX can't crash too badly. And B, I'm offset by the vast majority of the weighting of my portfolio. That's why I said I am always, shouldn't say these words. I'm always paying attention to my exposure of the markets. And right now, I am net short this one. That is very true. And it is an unlimited loss trade. But let's be realistic. Are we really going to find that it's 25? On the flip side, well, what if somebody thought that this was a good idea? Because, of course, maybe you can get more premium, right? If you sell this 33 put, you get 50 cents. If you sell the 35 call, well, I get 67 cents. Surely that's a better trade, right? Well, no, not even remotely close. I mean, obviously the premium will be better if you sell the call, but remember, the options market's efficient, and you should always assume that the premiums are there for a probabilistic reason. And this trade, unlimited loss to the upside, yes, we could have a flash crash. This is one of the things that I always tell people is trade your portfolio as if tomorrow is going to be a terrible day for you. Think about your worst case scenario. That's going to happen tomorrow. Well, not tomorrow, Tuesday. It's going to happen for you on Tuesday. How are you going to handle that? Do you want to be naked short a VXX put option when the rest of your portfolio is net long the market? No problem at all, because the rest of the portfolio will probably have a very bad day, but that position will be fine. It's not the same thing the other side of the equation. There could be a flash crash. In fact, I would say there will be a flash crash. There's already been several. There was one major one on May 6, 2010. There will be another. You will wake up one day and the market is just absolutely destroyed. And you have to trade every day as if that's going to happen the very next trading day. And that means just by default, selling unlimited loss calls on volatility ETPs is off the table no matter what. It is just off the table. But another reason why it should be off the table is it's just very inefficient trade. You have to spend an enormous amount of money hedging that trade, and you're going to burn into all that premium that you sold anyway. So why would you enter trades where you perfect trade, best case scenario, you get that 68 cents, best case scenario. Worst case scenario, it can be many multiples of that. It can be 1,000% worse than that. Why would you take on that risk if you've got nothing offsetting it? So it's just a very, very inefficient trade. And in general, I agree with you. In general, you would not want to be selling naked premium. The way that I do it, there's no risk to the upside for volatility spikes. So what I'm concerned about is the VXX going down too fast. Doesn't happen often. And if it does, the rest of my portfolio will absorb a little bit of that damage. I am a very, very safe trader. You're right. I mean, I have a philosophy of risk management above all else, and it sounds like a contradiction, but it's actually not. Okay, would you advise to wait to get assigned the expiring, a lot of all trend questions. Would you advise to wait to get assigned the expiring puts on VXX and sell calls on them on Tuesday? So what this gets into is there is actually quite a big difference. Let me load up a different... We've discontinued our VTS options service temporarily. I'll bring it back later in the year. I just want to make it a lot better. Where's my VTS options? VTS options paid. Yeah, this one's going to be fine. Let's find a new trade. So there is actually a very big difference between how I trade what I call the vol trend, which is what your question is, versus what we call the wheel of fun. So these are our option strategies within VTS options. The wheel of fun is selling out of the money premium on, indexes and individual stocks. And if we get assigned, quite often we allow that assignment to happen, and then we turn around and we sell covered calls very aggressively, very close to the money, to try to get rid of those shares. We're not trying to actually take assignment, we're just cycling through premiums. We're essentially collecting premium. And of course we use a stop loss, because anytime you're going to be collecting premium on the downside, it could go very far against you. The idea that hey, I was going to do it anyway, so it's risk-free. That's absolutely not true. Of course, there's risk if you're selling naked put options. But we have a plan for that to take assignment and sell aggressive covered calls or stop loss out. The vol trend does not do that because it's the VXX. And the VXX, if you took assignment on Friday, you are subject to the movement of something that has a beta factor to the S&P of about 2.5 times. It's about 2.36 times. The VXX moves that much faster than the underlying S&P 500. So it is not something that you want to take on weekend risk exposure on. It can really move against you adversely. So what we will always do is we will rotate out of the original position we're in during market hours. We will not take assignment, and then we will just sell a new contract. So today we are exiting one, and then we're getting into another within the same 1 or 2 minute window. And that's how this strategy is dealt with. For VTS options, if I was selling naked puts on the S&P 500 or, I don't know, one of the sector ETFs like utilities or something, in that case, yeah, they move slower. As long as the rest of the portfolio is balanced, sometimes we take assignment. Sometimes we make a lot more money, a little bit of a boost on those covered calls. Not vol trend. Vol trend does not involve taking assignment. Too much risk. Oh, there's a big yacht coming in. All right, we've been going for 1 hour and 6. I don't know. What do you think? Call it soon? Let's do a couple more. Maybe it was mentioned already in private or public streams, but QLD underwent a stock split. Yeah, announced May 11th. So did the VIXY for us. So did, of course, UVXY. We don't trade it anymore. VTS Options trades UVXY. But yeah, they had a long list of something like 22, 23 or something. There was a lot of splits recently this week. Paid to holders, it seems. So, I'll finish the question. Oh no, that's a different question from a different person. Sorry, the purple threw me off there. Yeah, so there's no follow-up here. So I assume you're asking, well, what do? We do nothing. Reverse splits in this case, they don't do anything to the underlying value. Again, it's just shares are multiplied, prices divided, and that's it. So we don't have to do anything. As far as the ex-dividend date, I didn't actually check it. I never take in dividends and, hey, I'm going to try to get that dividend and then exit my position. My positions are always based on what is the right position, regardless of a dividend date. So I'm not going to stay in an extra day to try to get that ex-dividend date. So I didn't even actually look at it. But I don't know. We'll see. You can look up the ex-dividend date and see when we were holding it. We've been in the QLD for a while, I think, for long enough that it's probably your money. If it's not, it doesn't matter anyway, because dividends are also adjusted. Dividend is paid, stock price is adjusted. Really no effect anywhere. Okay. Looking at the VIX daily spikes chart you showed, if you had to play those signals as aggressive instead of just going to cash, what general strategy would you use? Well, for me, cash is sort of the middle ground position. And it takes quite a bit for me to go full-on aggressive long vol. Just to give you a rough example, the tactical volatility strategy, it is short vol, net short vol. Right now, changes from time to time, but right now we're using long-dated VXX put options. It's active about 42% of the time, net short vol. In cash, about 55% of the time, and about 3% of the time, net long vol through long-dated VXX call options. So highly skewed to that high side. All of the things that I showed you, the 3 crashes that we avoided, and we basically exited all of them on the first or second day, none of them were big enough directional changes to get us to go from long the market to full-on long vol. They all kind of come into that middle ground for a while, and then if things really accelerate, then we can go on the other side. But cash, bonds, gold, utilities, that's kind of our default parking space for when percent moves. Sometimes point moves as well, but relative change values really shock the market. And then that way you can measure it regardless of the absolute level of volatility. I don't want to be in a position where I'm very worried my signals won't pick up on something because the VIX is 12. Whereas if it was 25, it would be hypersensitive to that, and I'd pick up on it immediately. Probably too quick. I'd be exiting too fast. I want to make sure it's relative to the value of the meaningfulness of the metrics, not the absolute level of the market. That doesn't make a lot of sense to me. So, because we are just at the whim of what the market does. Right now, the VIX is in the 16s. Yeah, it wouldn't take much to get a 10-point move. Well, it would, but not the same as from 10 to 18. 17 to 25 is a shorter trip, and 40 to 48 is a much shorter trip. That's just the way it goes. Taipei weather versus Singapore. I've never been to Asia and fear the heat, humidity. You have to like the heat if you're going to move there. I love the heat. Back when I was a pro golfer, I actually lived in Scottsdale. I lived in Houston. I lived in Florida, California. I lived in very hot places. I've played, tournaments, South America. I've played a lot in Asia, Asian tours, and it seems to me everywhere I went, it was really hot weather, right? I didn't play the European tour, which is quite oftentimes bad weather. I've only played the Canadian tour for 1 year, and weather was terrible there. But I love the heat. So for me, I can tell you it's going to be just fine. But I believe you're from Edmonton, aren't you? Yeah, you're going to have a rough go if you go to Asia and you're used to Edmonton. Edmonton, Canada, for anybody watching. I believe you're from Edmonton, aren't you? It's going to be a shock. I mean, it's one of the hottest countries in the world. Taipei is just brutally hot in the summer. It's max humidity, 38 degrees. It's uncomfortable. But I like it. I go running in the middle of the day. I don't mind it at all. For a Canadian kid, I don't know. What could be the ideal strategy for low VIX like today? Low relative VIX like today, surely. Because it is relatively low based on where it's been. It's not low considering long-term averages, but good strategies. I don't typically like to do that because it's very dependent on what the rest of your portfolio looks like. Nothing is ever truly standalone. So I could say, well, at this point, broken wing butterflies on the VIX index, VIX options, sort of skewing it out to make a larger net sort of surrounding maybe the 15 to 23 range, having the high side be less damaging than below 15. That might be a good trade. But I might be talking to somebody who has a portfolio that's skewed the other way, and now I've just amplified your market exposure. So I would have to know what the net bias of your portfolio is before I start actually saying, for you, your current bias is, 0.75 the market. So you might want to put in this. It'll balance things out. I can't blanket statement say this is good because I can only say that for me. I know exactly what my portfolio exposure is, but I don't know yours. So, all right, one more. The winner is this one. If you focus on preparing for flash crashes, why are your leveraged portfolio strategies in levered ETPs and not in risk-defined options? You could do both. The problem with doing, as you would refer to, stock replacement, like we do in the tactical volatility, is very inefficient for most people because it's highly dependent on the underlying price of the ETF. So if you're talking about trying to do stock replacement on the SPY, one contract will be $40,000 of capital, give or take. Whereas when we do stock replacement on VXX, the VXX has done its split, so it's now in the 30s, but that's far more accessible as far as efficiency goes. The difference between one contract and two contracts is massive. The difference between 23 and 24 is fairly negligible. So doing an entire portfolio with stock replacement would be only for people with large amounts of capital, and it just wouldn't be efficient. So what I try to do is, obviously my risk management, a lot of it comes from the fact that we exit very quickly to safety. And I actually sometimes get accused of moving to safety too quickly, which is just fine for me, but that's the strength of my strategy. I showed it before. I can show it for anybody who showed up late here. You're not going to see any periods of my portfolio where it would wow anybody on Twitter. our underlying portfolio has made 19.9% annualized since I launched my strategy. So at no point here am I going to be the type of person who's going on Twitter saying, guys, I just made, I'm up 50% in the last 3 months. I'm killing it. That just doesn't happen with my style of investing. But what also typically doesn't happen, and knock wood, of course, is that because I'm hypersensitive to risk management rather than chasing big gains, this as an underlying portfolio is a very good way to invest, in my opinion, because we exit quickly. Sometimes that means whipsaw, but there are, this is the leverage portfolio, kind of the same idea. This one has, annualized return of almost 30%, but same thing. There's no real periods here where it's going to wow you, but the strength is to exit quickly. So you could stock replace all of these. If you were really worried about it, you could do defined risk. And when you're doing stock replacement, because the underlying options are cheaper than the actual ETF, you have a lot of your capital sitting there in cash, and you're still representing the same position, but highly inefficient for smaller accounts. So that's why we don't do it. But I'm just basically counting on the fact that I'm not sure you'll find investors that are safer than me. As far as being so hyper-focused on risk management. It's really what separates what I do from everything else. I'm trying to give people at least a really good core for your portfolio. I'm certainly not the type that suggests that everyone in the world has to follow my portfolio and nothing else, right? But I do think that to have something that is so stable as the core, that still makes a very good rate of return, that would allow you to maybe take 20% or 30%. And if you want to go chase those other big strategies, I'm telling you, it's probably going to work out very badly. But if you wanted to do that, that's fine. But as the core, it has to be safe, it has to be consistent, and we have to exit at the first sign of trouble. I love the fact that I've exited every major crash and not had any drawdowns during any of them. Sometimes the flip side of that is you exit early, markets bounce the very next day, and you kind of look like an idiot. But I would rather look like an idiot occasionally than once every 5 years be a complete fool that rides something down. So, yeah, I'm kind of a small idiot on a regular basis is better than a very large fool once every few years. Put that on a t-shirt. All right, let's wrap it up. That's probably enough. Thanks everybody for coming, for the support. On your way out the door, hit the like button. That would be very much appreciated. And follow me on Twitter. Let me give you my Twitter handle, because this is, above all places, this is probably where I will notify everybody of future streams. I will always give plenty of advance, and we do these regularly. So thanks for all the great questions, and I'm going running right on that path right there. Stanley Park in Vancouver. It's awesome. Take care.